Three Federal Reserve governors just did something that almost never happens in the institutional world of central banking. While the financial press spent the first quarter of 2025 fixating on the pace of rate cuts and the path of core PCE, Michelle Bowman, Michael Barr, and Lisa Cook quietly inserted language into an internal Fed working paper that should have set off alarm bells across every institutional risk desk in the country. It didn't, because the mainstream financial media wasn't reading the footnotes. They never do. On this channel, we don't chase the noise. We track the shadows where true policy shifts occur long before they hit the headlines. And what's buried in those footnotes is one of the clearest institutional warnings about market plumbing failure that I have read in years. This isn't a video about whether silver is going to $100 or $200 or any number a retail newsletter wants to sell you. This is a structural analysis of a very specific and very serious problem that three of the most institutionally well-informed people in the American financial system felt compelled to flag on the record. That act alone, the act of going on record in official documentation, is the signal. And if you understand how carefully central bankers choose their words in formal documents, you understand that the signal is not subtle. Let's start with the document itself and the terminology at its center. The phrase that appears repeatedly throughout the relevant sections is physical commodity delivery obligations. In the context of regulated bank supervision, this term refers to a bank's contractual obligation to either deliver or take delivery of a physical commodity, in this case silver, upon the settlement of a futures or forward contract. For the better part of 4 decades, this language was essentially administrative formality. The mechanics of commodity futures markets operated on a well-understood assumption. The overwhelming majority of open contracts would never result in actual physical delivery. Market participants would roll positions, net out obligations, or settle in cash. Physical delivery was the exception, not the rule, accounting for somewhere between 2 and 5% of all contract settlements in any given delivery month on Comex. What the Bowman-Barr-Cook paper signals, with the measured but unmistakable language of institutional concern, is that this assumption is breaking down. The behavioral baseline that underpinned decades of risk modeling, that paper silver and physical silver are functionally equivalent and interchangeable at scale, is no longer safe to treat as a constant. The paper stops short of saying this in plain English, because central bank documents are not written in plain English. But the analytical direction is unambiguous. When a Fed working paper dedicates material space to discussing concentration risk within physical commodity delivery obligations at systemically important institutions, it is not engaging in academic housekeeping. It is flagging a vulnerability. In my years of dissecting central bank balance sheets, I've rarely seen red flags this bright buried in official footnotes. To understand why this particular vulnerability is so structurally dangerous, you have to spend a moment with Basel III and the specific accounting treatment it allows for precious metals positions held by banks. Under Basel III's standardized approach to credit risk, a bank's reported risk-weighted assets in the commodity space can be dramatically reduced through counterparty netting, the process of offsetting long and short positions held against different counterparties within a recognized netting arrangement. If Bank A is short 10,000 contracts of silver futures against counterparty X and simultaneously long 10,000 contracts against counterparty Y, the net reported exposure is 0. The gross exposure, the total notional value of obligations that exist in the real world, remains enormous, but the regulatory capital requirement computed on the net figure can be negligible. This architecture was designed for a world where the liquidity to execute that netting never disappears, where, if the gross positions ever needed to be unwound simultaneously, the market depth would absorb it. It is an architecture that assumes the paper layer of the market and the physical layer are always reconcilable. The Basel III framework, as applied to bullion banks holding silver derivatives, does not require those institutions to hold HQLA Level 1 assets proportional to their gross physical delivery obligations. It requires them to hold capital proportional to their net exposure after netting. This is the loophole, and it is a loophole that functions perfectly smoothly right up until the moment that physical delivery requests accelerate faster than the netting mechanisms can absorb them. The Comex data is where the abstract regulatory concern becomes a concrete, measurable problem. This analysis isn't based on speculative hype, but on a cold reading of Basel III capital requirements and the collapsing collateral math at the OCC level. As of the first quarter of 2025, total registered silver inventories in Comex certified warehouses stood at approximately 77 million troy ounces. To put that number in context, at the beginning of 2021, those same warehouses held approximately 400 million troy ounces. That is a drawdown of more than 80% over 4 years. It is not a rounding error. It is not a seasonal fluctuation. It is a sustained multi-year structural reduction in the physical metal backing the world's primary paper silver market. At the same time, open interest in Comex silver futures, the total number of outstanding contracts representing future delivery obligations, remained at levels that, when converted to troy ounces of physical metal, produced a ratio of paper obligations to available registered inventory that no risk model built on historical norms would have been designed to accommodate. Every ounce of silver in those registered warehouses was backstopping a multiple of that ounce in contractual obligations. The arithmetic is not complicated. The implications of that arithmetic are what the three governors are apparently finding impossible to ignore. The delivery request data reinforces this picture in a way that is difficult to dismiss. In the period from mid-2024 through the first quarter of 2025, the percentage of Comex silver contracts reaching their delivery date and resulting in actual physical delivery notices rose dramatically, from the historical baseline of 2 to 5% to figures exceeding 20% in several consecutive delivery months. A fourfold increase in the physical delivery rate, against a backdrop of an 80% reduction in available inventory, is not a market functioning normally under stress. It is a market in which the behavioral assumptions that made the paper system viable are visibly eroding. My regular viewers know we specialize in the divergence between what bankers say in press conferences and what they sign in technical audit requests. And that divergence is nowhere more apparent right now than in the question of who is driving this change in delivery behavior. The Fed document uses the phrase sovereign entities and their proxies, which is the institutional equivalent of speaking loudly in a library. Sovereign entities are central banks, state investment funds, and the financial vehicles through which national governments deploy capital. Their proxies are the commercial banks and clearing houses that execute trades on their behalf. The language does not name specific countries, and it would be inappropriate to speculate beyond what the data supports. What the data does support is a clear directional flow. Physical silver is moving from Western certified storage into Asian and Middle Eastern physical markets at a pace that the Western paper market's inventory cannot sustainably accommodate. The London Bullion Market Association's clearing data and the Shanghai Futures Exchange's warehouse reports both corroborate the same basic story. Physical silver available for prompt delivery in London and New York is contracting. The demand for that physical metal, from industrial users, from sovereign accumulation programs, from investors who have decided they want the metal itself rather than a claim on it, is not contracting. The cross-border settlement risk embedded in this divergence is something the OFR, the BIS, and now apparently at least 3 members of the Federal Reserve Board have moved from background concern to active monitoring category. The price data makes the structural stress visible in a way that is accessible even to observers without a background in derivatives clearing. As of mid-2025, the Comex benchmark spot price for silver was trading in the range of approximately 76 US per troy ounce. This is the price that appears on financial terminals, in ETF prospectuses, and on the screens of retail investors. It is the price that the paper market produces. It is not, however, the price at which large quantities of physical silver were actually changing hands in the same period. Physical silver premiums in Shanghai, the spread between the Comex benchmark and the cost of acquiring actual, allocated, immediately deliverable silver, were running at levels between $5 and $10 per ounce above the paper price in sustained trading conditions, with episodic spikes higher during peak demand periods. London experienced similar, though somewhat narrower, premiums, driven by the tighter integration between the LBMA and Comex clearing mechanisms. For me, this is about the mathematical reality of a system that has issued too many promises for a world that suddenly wants the physical reality. In efficient, liquid commodity markets, premiums of this magnitude and duration do not persist. Arbitrage eliminates them within hours, not months. When a premium survives for months, it is because the arbitrage cannot be executed, because the physical metal needed to close the gap between the paper price and the physical acquisition cost does not exist in accessible, deliverable form at the scale required. A sustained multi-month premium of $5 to $10 per ounce on a commodity benchmarked at $76 is not a market inefficiency waiting to be corrected. It is a market telling you, in the clearest quantitative language available to it, that the paper price and the true cost of physical acquisition have decoupled. It is the market admitting that the two things, a paper claim on silver and an actual bar of silver, are not the same thing anymore, at scale, under current conditions. What happens next is where the analysis necessarily branches into scenarios, because the future is not singular and the variables are numerous. But the scenarios are not equally weighted, and it is worth being precise about the logic of each. The first scenario is what might be called a managed regulatory recalibration. In this outcome, the signal embedded in the Bowman-Barr-Cook document initiates a coordinated regulatory response. Higher capital requirements against gross physical delivery obligations for systemically important bullion banks, mandatory increases in registered Comex inventories as a condition of continued clearing membership, enhanced reporting requirements for cross-border settlement risk in precious metals derivatives. The market reprices silver upward by 15 to 30% over a period of 12 to 18 months as the capital cost of maintaining oversized short positions increases. The premium between paper and physical narrows as regulatory arbitrage is reduced. No institution fails. No clearinghouse suspends operations. The system absorbs the adjustment with pain, but without rupture. This scenario requires regulators to move with both speed and coordination, and it requires the institutions on the wrong side of the adjustment to absorb losses without triggering broader credit events. It is the most orderly path. Whether it is the most likely path depends entirely on how much runway remains before the delivery math forces a disorderly resolution. The second scenario is a selective settlement failure, a partial localized breakdown in the delivery chain at one or more major institutions, managed through emergency rule changes similar in character to those the London Metal Exchange executed during the nickel market crisis of March 2022. In that episode, the LME suspended trading and cancelled executed trades after short sellers faced catastrophic bullion bank margin calls that threatened multiple clearing members simultaneously. The mechanism failed not because of fraud or mismanagement in the conventional sense, but because the paper position structure had grown disconnected from physical reality to a degree that became unmanageable under stress. A similar scenario in silver would likely involve a single delivery month in which requests for physical settlement exceeded available registered inventory by a margin that could not be covered through emergency borrowing from eligible but unregistered stocks. The likely regulatory response, mandatory cash settlement at the paper benchmark price rather than physical delivery, would resolve the immediate crisis while simultaneously validating every concern about the paper-physical divergence. The long-term consequence would be a structural reduction in the institutional credibility of Comex-based paper silver as a true proxy for physical metal. The flow of institutional and sovereign capital into direct physical ownership, already observable, would accelerate sharply. Premiums would reprice the true cost of physical silver permanently above whatever paper benchmark survived. The third scenario is a systemic settlement cascade, the tail scenario that risk managers are paid to model, even when they hope never to see it. In this outcome, the delivery failure does not remain isolated to a single month or a single institution. The counterparty netting arrangements that allow bullion banks to report near zero regulatory capital requirements for massive gross positions begin to unravel, because the counterparties on the other side of the net are themselves facing delivery obligations they cannot meet. The cross-border settlement risk that the OCC and the Fed have been quietly monitoring becomes a cross-institutional credit event. Risk-weighted assets at affected institutions spike simultaneously, triggering margin calls at a moment when the collateral needed to meet those calls, physical silver, is precisely the asset whose availability is in question. The feedback loop between delivery failure, margin calls, forced position liquidation, and further delivery pressure is the dynamic that makes this scenario systemic rather than merely painful. The probability of this outcome is low under current conditions. It requires the simultaneous convergence of multiple stress factors. But it is not a fictional scenario. It is the scenario that the Basel III framework was theoretically designed to prevent, and the scenario that the specific loophole in precious metals netting treatment may have made structurally more accessible than the framework's architects intended. The signal that Bowman, Barr, and Cook have sent is durable precisely because it is official. It exists in the documentary record of Federal Reserve analysis. It cannot be walked back, revised, or attributed to misquotation. For institutional risk managers, for treasurers at mining companies, for the compliance functions of funds with material exposure to silver in any form, through ETFs, futures, forward contracts, unallocated accounts, or streaming agreements with producers, the existence of this signal is a mandate to revisit the assumptions embedded in current exposure models. The specific questions that this signal demands are not rhetorical. Is your silver exposure physical and allocated, or is it a contractual claim on an institution's ability to deliver? Does your counterparty's ability to deliver depend on counterparty netting arrangements, whose integrity is contingent on a physical inventory that is measurably shrinking? Are the premiums you are observing in the physical market reflected in your current mark-to-market valuations, or are you carrying paper price exposure against a physical acquisition cost that has structurally diverged? These are the questions that the footnotes of a Federal Reserve working paper are asking in the indirect but unmistakable language of institutional concern. The system has been running on the assumption that paper silver and physical silver are always the same thing. The data from Comex warehouses, from LBMA clearing statistics, from Shanghai futures premiums, and now from the documented concerns of 3 Federal Reserve governors suggest that assumption deserves rigorous re-examination. Whether that re-examination produces a managed adjustment, a localized settlement event, or something more significant will depend on decisions made in the next several quarters by regulators, by the institutions at the center of the delivery chain, and by the sovereign and institutional buyers who are already voting with their demand for physical metal. That's the analysis. Now I want to hear yours. 3 scenarios are on the table: a managed regulatory adjustment, a selective exchange-level settlement failure, or a broader systemic cascade. Which trajectory do you think the data is pointing toward? Leave your reasoning in the comments, not your price predictions, your structural analysis. That's the conversation worth having, and it's the one this channel exists to host.